Welcome back to Global Crossroads, the podcast that deciphers the invisible threads moving the world economy. I'm your host, Alex, and today we are tackling perhaps the single most important financial dilemma of our era, the ultimate rivalry between the US dollar and China's surging economic ambition.
And Alex, it's a pleasure to be here. This isn't just an abstract economic fight. It's a story about power, technology, and what currency the world trusts, which ultimately impacts everyone, from a central bank governor to the person buying groceries.
Exactly. To put it in perspective for our listeners, the dollar has been the world's universal operating system, the iOS or Windows of finance, since 1944. But now we have the Asian dragon, China, growing monumentally and effectively building its own parallel operating system. Our guest today is Dr. Maya Chen, a leading expert on global monetary policy and emerging market finance. Maya, thanks for joining us. Thank you for having me, Alex. It's a crucial topic, and I'm looking forward to breaking down the complexity into clear, actionable insights. Let's start with context. Why should the average listener, the investor, the business owner, care about the dollar's hegemony versus China's growth?
It boils down to stability and cost. Think about why your price of oil fluctuates, or why inflation seems so difficult to tame right now. The answer is often tied to the dollar's position. When the dollar is weaponized, through sanctions, for instance, countries start to worry about their financial plumbing. China, as the world's largest trading nation, is saying, "We are tired of having to use a language we don't control, especially one that can be used against us." Their sheer volume of trade is what makes this a current, crucial problem.
So it's a risk management strategy for the rest of the world. And this leads us right into the core idea, de-dollarization. Maya, what is de-dollarization really? It sounds so dramatic, like the dollar is about to collapse. That's a common misconception. It's not a collapse, it's a diversification. I like to think of it not as turning off the oil spigot, but as diversifying the world's energy diet. For decades, every nation depended 100% on oil, the dollar, to function. Now, countries are actively seeking renewable sources, which are other currencies, like the yuan. The goal is to reduce dependency from 100% to maybe 60% or 50% over a long period. This is driven by the 2008 financial crisis and, more recently, geopolitical polarization. That's a fantastic analogy. And we can see this silent shift happening in central bank reserves, right? Absolutely. The data from the IMF is clear. Historically, the dollar made up over 70% of global reserves. That share has been gradually, I stress gradually, eroding. Alternative currencies, including the yuan, are filling that space. It's a slow-motion process, but it signals that countries are actively using risk management to guard against global instability and the potential for U.S. sanctions. So the first big takeaway for our investors is the world is no longer monolithic, and your portfolio shouldn't be either.
Exactly. You must monitor these shifts. Reduced dollar share implies lower long-term structural demand for the USD, and that can lead to increased volatility. Diversification into assets or currencies of key emerging economies is just smart strategy now.
Core discussion, the yuan's challenge. Let's talk specifics about China's countermove, the rise of the yuan, or CNY. China was the world's factory for so long, settling everything in dollars. How is that changing now?
The biggest tangible effect is in trade settlement. China is actively promoting the use of the yuan in transactions, whether they're buying copper from Chile or selling machinery to South Africa. The most relevant example is the Petro-Yuan initiative.
The direct challenge to the petrodollar.
Yes, since 2018, China has been championing yuan-denominated oil futures in Shanghai, convertible into physical gold. If even a small fraction of the world's oil trade shifts from USD to CNY, the dollar's daily demand, that exorbitant privilege we talked about, decreases. It's like China, the largest farmer at the global marketplace, is now saying, "I will accept my own tokens for my products." When Brazil accepts those tokens for soybeans, they gain global credibility.
That shortcut, bypassing the dollar as the intermediary, seems critical.
It truly is. China has established currency swap lines with over 40 central banks, allowing them to trade CNY directly for local currency and vice versa, without the friction and cost of converting through the dollar. And then there's the Belt and Road Initiative, where billions in infrastructure loans and contracts are settled directly in yuan, further entrenching the currency as a global trading instrument.
So as an investor, I need to observe more than just the dollar index.
Absolutely. You need to watch commodities. If major commodities like copper, lithium, or iron ore begin to be quoted and settled in yuan more often, that is an unmistakable sign that the structural demand for the dollar as a settlement currency is falling. You must grasp that new equilibrium.